Welcome back, traders and investors. I'm Brianna Valesky with Joel Elkanah, and we have Michael Hewson on the line. He is the Chief Market Analyst at CMC Markets. Michael, how are you doing today?
Yeah, good morning, guys. It's certainly been an interesting last few days.
I know you mentioned before we got on the live show that you were looking at the euro this morning. I think I almost read someone suggesting that the ECB announcement tomorrow, could it possibly bump up the euro at all?
Yeah, I think there's a danger of that. I think, investors and the markets have been getting particularly carried away with what the ECB might deliver tomorrow. I've heard numbers bandied about in the region of 750 billion, a trillion euros. I'll be very, very surprised if Mr. Draghi is able to do much more than 500 or 600 billion euros. And the reason for that is getting the required unanimity on the ECB Governing Council. Now, I think it's likely that we're probably going to get something, I think, because François Hollande, the French president, let the cat out of the bag yesterday. So much for central bank independence, you might say, but I think everyone knows that central banks aren't really independent, though they like to think that they are. So, I certainly think that, there's potential for disappointment. It really depends on, first and foremost, what the announcement is, and then whether or not the program is either open-ended or whether there are any limits on it. So even after the actual announcement, Mr. Draghi could face some very difficult questions in the press conference as well.
I've heard some people suggesting that the ECB won't be able to do QE in the way that they plan to. Like it's almost illegal for them to buy the sovereign bonds.
Well, I've heard that. The way that I think it could well be done is done according to the capital key of each eurozone country. So that basically means it's decided on the amount of contributions they make to the European Central Bank. Well, in that case, what that would mean is it's going to be very targeted, and it's actually not really going to help the countries that need it most. I'll give you an example. Any structure of the purchases is likely to be split along the size of the capital injection. So Germany, for example, 26%, France, 20%, 9.6% Italy, 15% Spain, and 13%. So essentially, the bulk of the purchases would go to the countries that actually have the lowest yields already.
I've heard some people also saying that Germany would have to leave the eurozone because it's so big and it could essentially survive on its own.
It could survive on its own, but its currency would soar. There are two schools of thought on this. There's the thought that basically Germany could leave the euro. If it did that, then obviously it would lose the benefits that the euro has given it of a fairly low cheap currency. If it was just on its own, then it's going to have the problem that the Swiss are currently dealing with, in that the currency would actually go significantly higher. Having said that, when euro-dollar was at 160 a few years ago, there weren't that many complaints from the Germans when it was up there. So, you don't really know how that argument is going to sort of fan out until you're actually faced with it. So, it's really a question of what's the counterfactual.
So you do think we're going to see QE, but not as much as people are expecting?
I think there's a distinct possibility of that. I think people are looking at QE and they're thinking that it's going to be the silver bullet that finally resolves the eurozone's problem. Well, I got news for you guys. If you think that QE is going to resolve the eurozone's problems, then I think you've been smoking something, because for a start, the reason QE in the US and the UK worked as well as it did was because bond yields at the time were around about 3.5% and 4%. So you had a significant impact in terms of the bond purchases. Sovereign bond yields here in Europe are already at multi-century lows. In fact, in some cases, on the short dates, they're negative. Well, that suggests to me that even with negative rates, even with very, very low record rates, you're still not getting the growth that you need, that the problem must be more structural in nature. It's not about the level of interest rates on lending money. It's essentially about the mechanism that's used to deliver that fiscal boost, if you like. And the LTROs, the TLTROs, there was good demand for all of them, but it didn't actually get down into the veins of the economy. And that suggests to me, despite the stress tests that we saw at the end of last year, which an awful lot of the banks passed, obviously Greek banks notwithstanding, that there is still a significant amount of problems within the banking system within Europe, because these banks are being asked to lend money at a time where they're also being asked to bolster their capital ratios and improve their balance sheets. Well, we found here in the UK, that's very difficult to do both at the same time, which is why we also implemented supplementary programs like funding for lending and obviously the mortgage assistance program called Help to Buy. So, the two mechanisms are totally different. They need to fix the banking system, and more importantly than that, they need to do the structural reforms at government level in each of the eurozone countries. And unfortunately, all that QE will do is it will just be a sticking plaster that's basically trying to put a mask over the numerous problems that there are in the euro area. And I don't think it will boost inflation in the way that they think that it will do, because a lot of the problems are structural.
Okay, we had some news out of the Bank of England today. You think that's going to be let's discuss that, see if that'll be any factor in Mr. Draghi's actions.
To be quite honest, for us, the Bank of England minutes that we saw this morning were a little bit of a surprise, because the two hawks who've been calling for interest rate rises since August last year have reversed their calls, and now we have unanimity on the Bank of England. No rate rises, and I think what it has done is it's made the prospect of any rate rises this year in the UK much less likely. In fact, I don't think we will see a rate hike this year in the UK, and for that matter, I actually don't think we'll see a rate rise in the US this year either.
The whole year, Michael. You don't think you're going to see rates go higher at all in the United States this year?
No, I don't. And the reason for that, Joel, is, it's fairly simple. Basically, you've got deflation in China, you've got deflation of struggling to meet inflation targets in Japan, you've got potential disinflation in Europe, and you've got falling prices in the UK. The US is not going to remain immune from that. You've already got a very strong dollar. I think it could well start to hurt you. The Fed has an inflation targeting mechanism, which is missing by a mile. And to my mind, even though the unemployment rate, the headline rate, is at its lowest level for quite some time, you've still got a significant amount of underemployment. You've got 93 million Americans that aren't working. The participation rate is at 62.7. So I think there's still a significant amount of slack there. So for me, I think the last thing the US needs right now, given the strength of the dollar already, is a rate hike. And I think that will basically stay the Fed's hand, particularly if the economic data that we've seen thus far continues to come in on the low side in terms of wage rises and price rises.
Okay, Michael Hewson of CMC Market Analyst at CMC Markets. He's joining us here. Well, you've been pretty good on the crude and the gold market. Could you just touch on those real quickly?
Yeah, sure. I mean, gold. I did a note earlier this week, or a video earlier this week, where I think the gold price is going to continue to go higher. I think we're going to see $1,340 an ounce. We've just broken out on an inverse head and shoulders on the downside, and that's the minimum level that I'm targeting on that. So I think gold's potentially got further to go, as long as we stay above the 200-day moving average. Oil prices, I'm still fairly bearish on until such times as we get either some evidence of an output cut from OPEC or some evidence of a pickup in economic growth forecasts. And the World Bank and the IMF have both downgraded their outlook. We've got plenty of supply. We haven't got an awful lot of demand, so I certainly think that the top side will be capped around about $55, $60 a barrel, and I certainly think we can probably go to around $35 or $40 a barrel. So 35, 55 on the wide there.
Okay, Michael Hewson, market analyst at CMC Markets, joining us here on Benzinga's pre-market prep from a view from across the pond. Michael, we'll be waiting to see that big decision tomorrow and be anxious to talk to you next time you're on to get your take on it.
Thanks so much, Michael. We
Look forward
always
to it.
love having you
Thank
as
you,
a
guys.
guest.